Hey everyone, and welcome to the Shipper Update. I'm Zach Strickland here with the illustrious and current economist, Anthony Smith. Anthony, I see you've got some housing starts and construction spending, so I'm guessing you're going to talk about some form of interest rate management, right?
I mean, we can definitely get into that. And I mean, really at the core, what we're seeing here, because if you look at the blue line, what you have here is construction spending for residential. In the green line, we have housing starts. And what we can see, if we trace the trend back here, so we see this blue line, trace it back, that blue line, which is construction spending, is above where it was during the peak right before the Great Recession, right in 06, 07-ish area. So we see now it's surpassed that rate. What hasn't surpassed that rate is the housing starts. And so we see, look at the housing starts line right here, the green line, trace that back, and we see that there was much higher. And so essentially, what this chart is showing is that there was more spending for less infrastructure right now. And that's going to be impactful, not just upstream, but downstream. We're looking at what consumers are going into right now.
So I love that you've pulled it all the way back and show us just inflation.
Yeah.
Inflation in action right here. So the same amount of money doesn't go as far, so we're not going to see as much. So we can't just say, okay, construction spending is blowing off the roof, and now there's going to be so much more activity than there was in 2006.
Exactly.
Not the case at all. But it is, I think it's still worth noting that we're still on our way up, it looks like, right?
We're still on our way up. And so that's the other big thing. It's somewhat concerning because some people are calling this a bubble, and I understand that. And maybe in some parts of it, I can agree. Usually we don't see those ease of financial institutions. So when we look at the bubble that built up in 06, 07, before the 08, 09 crash or recession, we saw that there were eases in the financial institutions that really allowed people who shouldn't have been qualified for access to housing. So
arms.
Yeah. So what we're seeing that now is that there's just so much demand, but we're not quite seeing that infrastructural setting where there's such access, easy access to homes ownership. What we are seeing, however, is those historically low interest rates, which is kind of making it a little bit more appealing for people to get in and making that demand a little bit higher and kind of keeping that demand high or robust, so to say. And so when we look at this, there's still a lot of demand building up. We're seeing that there's new permits still coming out that's indicating that there's going to be more housing starts. We're also seeing completion times extend. And so that's telling us is that those houses are taking, of course, longer and longer. There's bottlenecks everywhere. There's going to be bottlenecks here. But it's just, I don't know, it's impressive to see how high spending is compared to how low starts are compared to where we were pre-Great Recession.
Now, I think one of the things that I look for when I'm looking at data like this, especially on a chart, is kind of the growth pattern here. Like, you look at this looks obviously almost unsustainable. Now, we don't have the chart all the way back historically, but this collapse here, I mean, it's almost like when things rise really fast, they tend to have a lot more chance to just fall apart quickly. This, until the very end there in 2020, looks like it still has some pretty consistent growth. Are you worried, like, is this a thing? I mean, do you think that this is a more sustainable growth pattern than we've seen in the past?
I definitely think this is more sustained, and there's going to be, I think, unfortunate realities for some individuals, some Americans, in that line of that K-shaped recovery scenario, especially when we're looking at the other side of this pandemic. I think that phrase is probably overused by now, the other side of this thing. But when we're looking at that, I think there's going to be sustained rise for a lot of those individuals that are looking to get into homes. The other thing is that there's so many underlying trends, and this, I could do a complete 30-minute diatribe on the underlying trends when you're looking at things that are small, like the buy now, pay later over time, things that are kind of starting to make its way. Consumers are kind of taking on more debt than what they should. We're looking at some of those automotive payments that some people may have taken on throughout the early parts of the pandemic, may have been really tightening their pockets or loosening their pockets because now they're really accountable for this large car payment that they might be in over their
over their skis.
Over the skis.
Yeah.
As they look, 5, 6, 7 months down from now, where the loan is more than the actual value of the car. So that's going to be one of the biggest aspects. I think in our next chart, we also have what construction spending is looking like on the non-residential side, if I'm not mistaken. And as you can see, of course, 2020, around that March timeframe, then it's gone down. And that makes sense. Of course, offices, things like that, aren't going to be in as much demand. But this, surprisingly, is going to be a segment I'm going to be watching closely to have some type of recovery or some kind of subtle sustained growth going into 2022 and of course into 2025, I would say, because of that, of course, infrastructure bill going into play, highway infrastructures, things like that. It's going to kind of start to play slowly but surely into this segment. I think there's going to definitely be some subtle increases, maybe for offices. Don't get the hopes up there, but warehousing for sure is going to be another factor to play into here.
For sure, it won't be the same way as we saw before. Thank you so much for that, Anthony Smith.